Now, the last 2 quarters of 2011, they were challenging, to say mildly, for hedge funds, and that left many of them underwater. Here to tell us why and how they hope to change that circumstance, we have Carrie McCabe, founder and chief executive of Lasair Capital. Carrie is also the former chief executive of Blackstone Asset Management. Always a pleasure. Thanks for coming in.
Happy to be here, Pimm.
The idea, just explain what this means when we say, hedge funds underwater. Is that measured against a particular benchmark?
Depending what type of hedge fund, they will use the S&P or the NASDAQ. If it's an equity fund, if it's a credit fund, it will use something else. So whatever is relevant for the underlying securities, usually.
Okay, so they got this challenge. They had a lot of volatility because of what went on in Europe and the linkages to
all the
U.S.
volatility,
stocks.
Exactly, Pimm. All the volatility started in July when the economic numbers started softening in the United States. And to give you 2 quick examples on that, if you look at 2% days this year, and normally there's about 250 trading days, 66 of those, or a quarter of trading days this year, moved more than 2%.
A quarter? Do that again. A quarter of all trading days moved more than 2%.
And if you went back to 2005, 0 moved 2%. If you go to 2006, 2 days moved 2%. And in fact, there were something like 10 days this year that moved, or last year, 2011, that moved more than 4%. So the volatility is just huge.
So this is a different environment.
It's a different world. And on top of that, too, especially having to do with stock picking, there's an option on the Chicago Board of Trade that tracks the correlation of the stocks in the S&P 500, so how much they move together. It went from 50 in July up to 90, so everything was moving together. So a very challenging stock picking environment.
All right, so how are the hedge funds going to recoup their returns in 2012? Well,
one of the great things about the hedge fund format is you can go short the market. And your guests today have been talking about sectors. And, indeed, last year the best performing sectors, financials. Financials was the worst performing, along with basic materials, down 18 and 11, right? And it's having a bounce so far this year. The best performing were very defensive. People did move defensively the middle of last year for the Europe and the economic numbers into utilities, one of the best performing, as well as consumer staples. But the really interesting story coming out of hedge funds, and one of the advantages to the hedge fund format in this, is the dispersion within the sectors. So, for example, you look at how much the longs went up in the sector and how much the shorts went down. And the sector that had the most dispersion, not surprisingly, was technology. And so the longs, you could make a lot of money on both the short and the long side in technology. And in fact, if you look at hedge funds for last year, many of the ones that did the best had a lot of trading in technology. To give you an example, Apple, if you held it all year, you made 25%. So you didn't even have to trade that. But Netflix, on the other hand, if you were long Netflix up until about August or September, you made 76%. But after they made the changes in their distribution and the streaming, you lost 70% in the fourth quarter.
So in a sense, what you want is you want expertise in a particular sector, but that's not correlated to something else.
And to be active.
And to be active. Carrie McCabe, thank you very much from Lasair Capital, sharing your thoughts about hedge funds. Appreciate it.
My pleasure.